shipping document took on in the sales and collection cycle. Some of the inherent risk associated with the acquisition and expenditure cycle, what your concern here is an understatement of liabilities. So if your concern is an understatement of liabilities, which assertion do you think takes on greater importance? Or if you're concerned about understatement, John? Exactly, right? Because remember what we said, occurrence is concerned with overstatement and completeness is concerned with understatement. Right? So when you think about it, if you compare the acquisition cycle to the revenue cycle, how likely is it if a company is trying to manage earnings, how likely is it that they're going to understate sales, right? They're rarely going to understate sales. If there's going to be problems, then they're looking to overstate sales. So that's why the occurrence assertion is really important in the sales and collection cycle, or that's where what your risk is. And then on the flip side with the acquisition and expenditure cycle, if they're going to manage earnings or try to grow their, make their income seem better than it really is, then they would try to understate expenses, not overstate expenses, right? Okay, so we're concerned about unrecorded liabilities. So errors can occur from ineffective internal controls, right? So if you don't have good internal controls, let's say you don't have good internal controls over the receiving process, and that the company doesn't always record the recognition of a liability when they receive the goods, right? That would lead to an understatement of the liabilities because you would have received the goods or services, but the company would not have recognized the liability associated with that. Fraudulent financial reporting could result from reporting liabilities or expenses in the incorrect period, right? And so again, if you're trying, if companies are committing fraudulent financial reporting and they're trying to do that by managing the expenditures or managing liabilities, they're going to look, right? So cutoff tests become really important, right? And we'll talk about a search for unrecorded liabilities. Also looking at non-cancelable purchase agreements, right? So we talk about purchase orders, and purchase orders are really a contract, right? Because it's what the company issues to a vendor for services or goods. And so it's really important. Remember in the case that we went over, one of the things that, one of the issues is that the auditors only confirmed the terms of the contract, right? But they didn't evaluate the terms. And in that case, it was a contingent sale, which under, financial accounting standards, you can't recognize that revenue if you have a contingent sale. The important thing with purchase orders is to also evaluate the terms of the purchase order, right? Because you want to know if the company has some type of agreement where they can't cancel, then they've basically guaranteed that they're going to pay for that, right? That they've accepted that those goods, that they're going to accept those goods or services. The other thing you want to do is sometimes when you have these agreements, the auditor has to evaluate it in terms of market. So this is again where there's more judgment involved. Is there a significant decline in the market so that the value of those goods are no longer what they were when the company entered into the agreement? The other thing is you want to see if companies are capitalizing expenses. Why would a company want to capitalize an expense? What do you think? Think WorldCom. John? Right. You hang it up on the balance sheet. Because if you hang it up on the balance sheet, by capitalizing it, that's what you're doing. You're hanging it up on the balance sheet. And by hanging it up on the balance sheet, it's not flowing through your income statement. If it's not flowing through your income statement, then your net income is going to be unaffected by it, right? You're going to increase net income essentially because you're not recognizing that expense. And that's essentially what WorldCom was doing in a nutshell, right? They were capitalizing expenses that should have flowed through the income statement. So that's another area that is important to look at. So let's take a look at Exhibit A2 at the assertion. Excuse me. Page 320, yes. Let me get my glasses. So what Exhibit A2 does is relate the assertion and the risk as it pertains to the procurement process or acquisition and payables process. Okay. So what you'll see is that, for example, with the balance assertions related to balance sheet accounts such as accounts payable or liabilities, you'll see with completeness there's a high risk there, right? Because what an auditor is going to be concerned with is an understatement of liabilities or unrecorded liabilities. Valuation and allocation is also going to be a high risk as well. Again, if the company has non-cancelable purchase orders, the auditor is going to look at whether or not there's a significant decline in the market value. So when we're thinking about the assertions, because remember, we're thinking about where's our risk, right? Where's the risk that there could be a material misstatement in the accounts and it not be detected. And so again, and as the auditor is going through the audit planning process and they're assessing inherent risk, they're assessing control risk, these are the types of things that they're doing. They're thinking about what assertions, where's my risk, what's the greatest risk with respect to liabilities, unrecorded liabilities. Then they look at the process that the company has in place, such as the control process, to determine if the control process is effective so that it would detect or prevent an error from occurring and not being detected.